The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
It's Policy Week at CoinDesk. All week long, coverage at CoinDesk will focus on the crypto industry's reckoning with regulation. Indeed, the Fed is set to release a report on stablecoins following comments from policymakers, including Treasury Secretary Janet Yellen, Senator Elizabeth Warren, and SEC Chair Gary Gensler, warning of the unique threats posed by stablecoins to the stability of the financial system. And joining us now to discuss is Stephen Kelly, Research Associate at Yale University's Program on Financial Stability. Hi there, Stephen. Thanks for joining us. So what do you expect to come out of this Fed report on stablecoins? And what would stablecoin regulation look like in the United States?
Well, I don't expect much out of this Fed report. That's kind of par for the course for these larger Fed report undertakings. I think they'll look for a lot of feedback from market participants and others when they put this out, but it'll really be a pros and cons, kind of things we already know. I'm not expecting many surprises out of this Fed report, not least because we have this President's Working Group report kind of in the background also coming in October-ish, maybe early next month. So not expecting much. That being said, it'd be nice if they put it out. They were talking September, so we'll see when that comes out. It's still unclear what regulation would look like for stablecoins, what exactly policymakers are thinking. There's been news out of the White House that they're looking at sort of a bank-like regulation for stablecoins, whether that be sort of a partial charter or full charter. If they're regulated like banks, they'll become banks. They'll just get consumed by banks. If a stable coin has to meet the regulatory requirements that a bank meets, JP Morgan Chase will just buy it, and that'll kind of be the end of it. There's a lot of talk about doing these sort of partial charters. The argument is, these are payments firms. They're not. What if they don't take deposits? Can't they get a little slack kind of on the chartering situation? And I think that's a risky route for policymakers to pursue, especially given the growth we've seen in stablecoins. Deposit insurance is typically cast as kind of this consumer protection policy. And we kind of feel, I think it's kind of generally accepted even in the crypto community, that stablecoin investors don't really need protection in the way a depositor would. But what's important about deposit insurance is that it allows us to make payments. It allows us to transact at par value because, we have certainty of the value of our checking accounts and things like that. And so if stable coins want to be a long-term payment mechanism, they may need bank-like regulation, for their own sake, beyond the investor risk, just for the future of payments.
So, Stephen, if you were to talk to a stablecoin proponent, they'll say that, hey, look, there's nothing they're doing that's any different than banks when it comes to fractional reserves, but they've created this incredibly wonderful, innovative thing. Regulators hate innovation, that they're fighting stablecoins and destroying? Like, what's going on? Is that really what's happening, or is it in fact something not right with stablecoins that would require them to not be able to do fractional reserve banking, essentially?
Yeah, I think the important thing to remember is that with fractional reserves is that we kind of, as society, we've kind of made this public-private agreement with banks. Banks can do fractional reserve, and it's often forgotten, but they create the bulk of the money supply for all the Fed gets, all the attention the Fed gets about its money printer. It's bank loans that create most money in circulation. But we kind of have this deal with the banks that, you have to kind of let your regulators in the door, and you have to pay for deposit insurance. And, in that situation, we'll give you access to the discount window. So we don't need to worry about fractional reserves. It's not my sense that regulators are particularly anti-innovation, but it's reasonable that they might be extra cautious with financial innovation because that's typically what precedes a crisis. I think to the extent stablecoins intertwine themselves with the traditional financial system through the reserves they hold and what backs them, and whether or not they become a payments vehicle, regulators are going to be concerned about their stability in crisis, and have every right to sort of dig into that and be skeptical of financial innovation in that sense.
Just quickly, we're sort of running out of time, but what do you think is the likelihood that the U.S. will issue a central bank digital currency?
I would say it's slim. They have these other initiatives already going, things like Fed Now for real-time payments. Most dollars are kind of digital. So really kind of the question we're asking now is just how much does cryptography basically come into the payment system? And that seems reasonable. But I really don't see any urgency for the Fed to implement a CBDC outside of sort of onboarding people who aren't currently being serviced by the financial system. And it's not clear the Fed has the legal authority to do that or wants to really be in that business, because it grows their balance sheet and it involves them in the business of banking in the way they might not want to be. And there are other solutions like postal banking and things like this. So we'll see. It strikes me as slim. We'll have to see if the pros outweigh the cons for them. I imagine the technology is appealing, but the rest of it is not so much.